thinking about debt financing, thinking about your capital stack, thinking about how to put things together, what makes sense for the types of companies you're looking to acquire, the industries you're in, thinking about current macro. I know we've talked a bit today about macro level forces in the world. Everyone's expecting an announcement today, very exciting. Whether that changes things, we can talk about. But just talking about debt, how to make it work for you, the right options available, and hoping to have a good conversation today. My name is Jennifer Stapleton. I am the co-chair of private equity at a law firm called Benesch. Benesch is an AmLaw 150 firm. We have offices in New York, Chicago, San Francisco, Cleveland, and Columbus. So we span both the Midwest and obviously the coasts. Have been involved in the search fund and independent sponsor space for 2 decades now, not to date myself, but really like working in this community, like supporting our independent sponsors and our capital providers. As we've mentioned, this space has grown a lot over the years and changed a lot, and it's great to meet everyone and have everyone here today, so looking forward to a great conversation. Would like to introduce our panelists. I'm going to have them do their own introductions. Tom, start with you.
Hi, Tom Goila with Comvest Partners. We're based in West Palm Beach, Florida. Popular place to visit in the first quarter. Come on down and see us if you are sick of the winter. Comvest is an asset management firm with over $12 billion of AUM. I'm a partner at the firm, focus on unitranche and senior debt, as well as capital opportunities. We generally finance firms from 5 million or so of EBITDA up to 50 or 75. Look to do unitranche as often as we can, or again, capital opportunities, which can be pref equity, take many different forms of capital, which can be relevant to the group here.
Thanks. Jonathan Saltzman, I'm the managing partner and founder of Torque Capital Group. I started Torque about 15 years ago after spending about the same amount of time in private equity and investment banking and corporate finance. We only invest in manufacturing businesses and are largely focused on transportation and industrials. So really that means automotive is big for us, aftermarket and OE automotive, trucking, power sports, marine, aero. We've taken a niche focus to being an independent sponsor. We believe that what we bring to the table that's different from other folks, including funded private equity firms that might be generalists, are having done it before, having seen it before, industry relationships, operating partners. We know how to deal with customers, vendors, supply chains, footprints on the manufacturing side. So today we have 5 investments, 2 of which are wholly owned, 3 of which are kind of relics of old deals and joint ventures and minority stakes and so forth. But they're all in and around automotive, trucking, parts manufacturing. Typically start at high single-digit EBITDAs when we buy stuff, and hopefully grow them to 30, 40 plus million of EBITDA before we sell them.
Hi, I'm Liddy. I'm a co-founder and co-managing partner of Mizzen Capital. We're a private credit fund. We love working with smaller businesses under 15 million of EBITDA, and the reason we do is because we like having people really have active participation alongside us and strong alignment. We're very open to independent sponsor partners. We provide primarily debt. We'll put a small bit of equity in, but when people come to us as independent sponsors, they're often asking for a lot of equity. We have a lot of partners that provide the equity in our deals. So we can provide the whole thing, but we stick to our knitting, really focusing on debt. We'll do transactions up to about $40 million, and this is unusual, we'll do little deals too. So we're very open to roll-ups, and we'll start with as little as 2 to 3 million and roll all the way up with you. We love growing alongside our portfolio companies. Primarily, we're in 4 sectors. Manufacturing, particularly niche kind of manufacturers with a lot of supply chain embedment. We have IT and software. We love SaaS businesses. We do services businesses, primarily business services, done a few healthcare services as well, and then energy transition. That's a little unusual. The rest are pretty much plain vanilla and what you'd expect to see. We are very active right now. We have 3 operating funds. So if you've got deals, please come see us. And if we can't help you, we'll refer you to someone who will.
I'm I'm Bob Puopolo, an independent sponsor at Epic Partners. We're focused, like Jonathan, on one sector, education and training. Although the way we think about education and training, it's about as broad as you can possibly imagine. If it looks, tastes, smells like education, or sells products or services to educational institutions or for educational purposes, then it's something that's of interest to us. We have been doing this for more time than I care to admit. Before they even conceived of the name independent sponsor, we started doing deals on this model, and invest a little money, earn equity on other people's capital, management fee, board seats, and lo and behold, it's a whole sector now where they have big conferences. It's amazing. So we've got 3 portfolio companies, one of which was a rollover from sort of a predecessor from an earlier deal. 2 active companies. One is a charter school management business. We own a network of charter schools that educate students who have dropped out of high school or are close to dropping out of high school. We have a training business providing training to small and medium-sized companies, all kinds of content, very short programs. And we've been in kind of a dozen companies over the years. We have a signed term sheet now for a highly structured equity investment. We're just starting the financing process. Hint, hint to those of you out there who do highly structured equity deals in a doctor of osteopathic medical school that we're super excited about. So I'm delighted to be here, and I suspect I'll learn from my panelists and at the same time try to share a few insights based on our experience.
Azhar Quader. I'm a managing partner and co-founder and founder of Queens Court Capital. It's an independent sponsor. I started 6 years ago. When I started, it was just myself, my dog, and my laptop. We've grown now. We've deployed close to $200 million across a number of platforms. Have seen full sales, partial sales, and dividend recaps. We have 3 active portfolio companies. We've had 9 platforms. We've sold a bunch of them. Every single of those platforms have gone to market for financing on debt side, but not at the outset. We did all these deals all equity initially. Happy to discuss that when we speak. We focus on special situations in 4 industries: consumer, industrial, B2B, and healthcare. Special situations include carve-outs, restructurings, and complex buyouts, but it all in the lower end of the middle market. And it's a pleasure seeing you all today, and look forward to this panel.
Wonderful. Thank you, guys. So for a new independent sponsor who might be new to the space, and maybe there's some level of sophistication, maybe not, how do you start thinking about what makes sense and what doesn't make sense? Obviously, both equity and debt financing have become more creative, more varied, more flexible, and with that has come maybe a knowledge curve to learning what all the options are. If I'm a sponsor and I'm thinking about a target company or an industry, how do I start to think about the types of debt financing available to me, whether it's a traditional commercial lender, unitranche, and how do I think about what makes sense for the businesses I'm taking a look at, or the business plan or a roll-up strategy that I have?
Let's start.
Yeah, I mean, I'll comment. At least from my experience, the SBIC funds in particular have been extraordinarily helpful in giving very quick lender reads if it is a situation that is financeable at the outfront, meaning there's in-place EBITDA. It's a regular way transaction like a roll-up, or But if it's a complex deal, and we traffic in a lot of complex deals, as Liddy knows. It's very hard to find financing up front, but you can find financing once you've made these businesses less complex or you've made it a little bit easier to finance. But whenever we look at situations, my first calls are usually to the SBIC funds. I have several friends in those, and usually that's a good tell whether or not a deal is financeable.
For us in our sector, education and training, it's very light from an asset point of view, depending upon the 90% of the deals have very limited assets. So traditional banks are usually not good candidates for us, and so we focus on talking to the SBICs and BDCs. You know, there are a number of business development corps that have similar economics, similar structures to SBICs that are very cash flow focused and lend off of a multiple of cash flow, and that's who our universe is when we start thinking about debt providers. If you're investing in more asset-intensive businesses, then I think the commercial banks are more of a candidate. If you can, you know, kind of deal with some of the vagaries associated with dealing with commercial banks, kind of the risk-on, risk-off sort of mentality, you know, some of the challenges. We do talk to a few commercial banks that like our sector, but it's a pretty limited universe.
I just want to reinforce that SBICs should be everyone's first stop for everything. I think that was logical. But we do actually have a lot more flexibility than some other types of funds. Since we'll do senior secured, we'll do unitranche, we'll do mezz, we'll do structured equity as a group of funds. Our particular fund is unusual in the sense that, as I mentioned, that we'll do really little deals going up to kind of mid-sized deals. And so the objective for you when you're pitching us is two things. A, get in early. It's really hard for us to respond once you've got something highly structured and you're putting it out in an auction situation. Often credit is looked at as generic. We don't think of it that way. We think we're lending to people and just encouraging you to think about it the way we think about it. It'll be easier for us to get along, which is think about bringing us into the discussion as you're having it. Introduce us to your ideas, your company. It's always cheaper to use us than it is to use equity. So maximizing your debt got to be your first priority. And unlike some funds, we'll also work through the negative equity, negative EBITDA cycles for you if we can see light at the end of the tunnel and if there is some other means of exit. So if you've got strong enterprise value along with maybe negative cash flow, and you might have a personal guarantee on the other side of that, or collateral that instead of sending it out to a group that's going to give you equipment financing, let us use that as collateral, and you can get a different kind of leverage on it. So we once did a pretty large transaction. Well, it was tiny to start with. We're now up to $20 million, but it was a $5 million initial check, negative EBITDA. Company grew 3,300% in a year, was then bought out by a very large private equity group. Why did we do that negative EBITDA cycle at $5 million? Because Marilyn, my partner, and I decided it wouldn't be so bad in the worst case scenario to have a few ski houses. So we, took a mortgage and we said, okay, fine, we'll give it a shot. It was a great company, and that was really the driver. But you've got backups, as is really what I'm implying, and being aligned with you guys as the sponsors is what we're really looking for. Great company, great ideas. Great cash flow is great to have, but not a necessity. You can think about your other assets as well, with SBIC funds in particular, tend to be a more flexible class of lenders.
It definitely is very dependent on the type of business you've got and what the model is. So just to contrast to Bob's experience and Bob's focus, I mean, we own car parts businesses, so we've got tons of assets. We've got equipment. We've sometimes got buildings. We've got high quality accounts receivable. We've got saleable inventory. So for us, the commercial banks, the regional commercial banks in the Midwest in particular, they love lending in situations like that, which is great news, especially back in the 2010s and so forth when we were borrowing at LIBOR plus 2 or 3%, which meant we were paying 2 or 3%. And, that compared to, some more expensive debt, at the time that was maybe 7, 8, 9%, right? So, whereas today, I think our thinking's evolved a little bit for a couple of reasons. Number one, the spread between, now that commercial debt, which is, now at SOFR plus, 4% or 5%, you're already at 10%. So the spread between that and the direct lenders whose rates haven't gone up proportionally with the commercial banks is much tighter, and so it makes the cost of going outside commercial banks much more palatable. But more importantly, right, we've been through cycles. You'll go through cycles. Every business is going to face adversity. It'd be naive to think they don't. And so, more important than rate, to me, and we've learned this the hard way and the easy way, is flexibility, and who's going to be there and who's going to be able to deal with some of the challenges and issues and problems that your business is facing. Who's not going to kind of pull the rug and commercial bank their first answer will be go put more equity in, and that's not where we are at that particular moment in the investment. And you also have to remember that no debt capital is permanent. So you go for what's appropriate for you, for the situation and for the cash flows and for your KPIs and your metrics. What are your cash flow needs? What's my M&A strategy? How much can I afford from a fixed charge perspective and from a leverage perspective? And then if you hit your numbers or beat your numbers or you improve or things go the other way, you might have access to a more appropriate lender, a couple of years later, and that'd be a success for your initial lender. That'd be a success for you, and that'd be a good new relationship to start from another lender. So, unlike equity, you could think of your debt profile as a little bit more fluid and just appropriate for what your business is at the time.
Yeah, a lot of good points here. To echo Liddy, I think starting early is one of the key components. There are a lot of different types of capital out there, a lot of types of lenders that are out there that can be flexible, that can do different things. They can either stretch on assets or stretch on cash flow, or look at some other alternative. What's the intrinsic value of the business? If there is negative capital, negative EBITDA, maybe there are stores that are mature, but you're expanding, so EBITDA is negative, but there is actually an enterprise value. So, starting early, having those conversations early, I think is really, really important. We have a situation right now that we're working on actively where it's us versus a commercial bank, and we're 100 basis points higher, but we have very limited amortization. We have the ability to expand. And so the borrower is saying, hey, rate's not everything. A lot of times flexibility, what's the best way to get a return on equity? And sometimes maybe interest is not the most important component.
Well, let's talk a little bit about that. When I'm new to term sheets, and I've got 2 or 3 I'm looking at, you've kind of touched on a few of the terms you might focus on, but maybe some lessons learned or some things, especially in the current market, you would focus on. What's really important? If it's not rate, what do you really want to focus on in those term sheets and comparing different options?
Yeah, I'll start, but for me, it's what's the total package look like, and where are you today from a business, and where are you trying to grow? I haven't seen a business that's not trying to grow yet. Maybe there's one out there, but and so what does that mean? What kind of capital is available from a debt perspective if you want to make an acquisition, if you want to expand a plant, if you want to purchase equipment, whatever it may be, making sure you understand how that capital is available versus what's in the term sheet is critical. And so really trying to understand what this deal looks like today, 1 year from now, 2 years from now, and maybe it is a bridge. Maybe as Jonathan said, you need to start off and go to 1, 2, 3 years, and then find the new source of capital that will give you something different. But understanding that and at least having the plan in place to know an outline in your mind how it's going to work, I think is critical for longer term success.
I think when comparing term sheets, I think first of all, rate isn't just interest rate. Effective rate, includes the cost of the lending relationship, whether it's there's monthly fees, there's audits you need to pay for. You've got some strain on your CFOs and your controllers and your business owners in terms of managing and monitoring the credit. So think about the cost of the debt as more than just the interest rate. But again, flexibility for me is far more important than interest rate, and within a band of market. And so by flexibility, I think some of the key terms to look at, right? Amortization, to Tom's point, I mean, interest payments are a necessary evil, but if you can have that money outstanding, and especially in your first couple of years of ownership, you don't have to repay at least the term part of your facility. That's an incredibly powerful tool to be able to invest in CapEx, in M&A, in R&D, whatever else it is you need to invest in that's going to actually increase the equity value of your business. So amortization is one. And then obviously from a covenants perspective, right, it's, yes, there are the specific metrics around what's your fixed charge and what's your debt to EBITDA, but you really want to focus on financial flexibility, especially in the world of we can't predict. We know things are going to go differently than what we expect. We don't know how they're going to go differently or why they're going to go differently. So I would encourage you to build in, a significant amount of cushion to what it is you think you can afford for those what ifs, and for both opportunities and issues. So it's really financial flexibility that comes with fewer covenants, more loose covenants, and including not just financial covenants but restrictive covenants around what I can buy, what I can invest in, and so on and so forth.
I appreciate the discussion from an independent sponsor's point of view about covenants, because that's a really important thing. And what that really speaks to is alignment, which is a watchword for everybody on this stage. We all have to be aligned. And everybody in the audience too. It's like the word you want to make sure you're right on. So when you're looking for a lender, also this is sponsored, equity people as well, but when you're looking for a lender, don't just think about the usual suspects. Figure out where you are. If there's a location, for instance, a lot of times there are tax benefits. There are even funds. Stonehenge is here. I saw them yesterday. I don't know if they're here in the audience right now. There you go. Hi, sorry. Yeah, they have state-focused funds that are very motivated to try and help people operate in certain locations, like rural Utah, I happen to know. And so there are these things that you need to do a little extra legwork to figure out if you qualify. Because if you do, their alignment with you is going to be very strong because they have tax motivations. Or if you're doing a certain type of transaction, an energy transition transaction, for instance, there are funds that will fund those tax credits and dramatically reduce your cost of capital. So don't just think about the normal senior debt, sub debt, it goes way beyond that in terms of your options. But if you're sort of doing a plain vanilla deal, going back to our general alignment, we're going to be looking for minimal amortization. And that's our way of competing with banks, because it's all about, for you guys, it's all about cash flow. So we are also, as SBIC funds, capped in our cost of capital. Another thing you all should know that we generally don't advertise, but because you are here, I'm giving you that inside information. So we can't go above 14% if you give us warrants. You may think warrants are expensive, but actually it's cheaper for you in lots of cases to give us warrants, so we can't charge you more than 14%. And otherwise we can go up to 19% if rates increase on a floating rate deal. These are just little details that you're not going to know unless you, and it goes on from there. I've just given you two little snippets. But the other thing to think about is how fast can you get your deal done? We just recently did a deal in 6 weeks because the borrower, who was going for another one of these little pocket things, an SBA 7A loan, great cost, low cost, with a bank, she'd been working on it for almost 6 months. And she was acquiring a company, and she was at the end of the rope. She didn't have much time to do it, so we got it done. And now she's going to stick. We thought, oh, great, she'll take us out in a few weeks because it was under 1x levered deal. It was a great deal for us, but also for her. And she's sticking with us because she wants to do more acquisitions. It's really hard to get a 7A loan to line up with your timeline. So it's not just money, it's also service, it's also responsiveness. And when you're dealing with When you get on a phone and you've got half the investment committee on the phone with you on those calls, you get a lot more, you get a quicker response than if you're dealing, and no offense to the banks in the room, love banks, they're our biggest LPs, but the reason they come into our fund is because they can't do what we can do. The regulatory constraints are very different. So that's another alignment issue, is timing. How can we really meet your goals? Our motto is your success is our success, and we believe that. When you guys go out and run a company, every day you wake up, you're working there, we know you're working for us, and we appreciate it.
Yeah, I'm not sure there's much more to add, except maybe focus on one element of financial flexibility, which sometimes gets kind of buried in term sheets, which is the dreaded excess cash flow sweep. As a general matter, companies want to, one should, we do, want to keep as much of a cash on our balance sheet as possible, just for a rainy day. One doesn't know what's going to happen out there in the world, and so one term that lenders most in our deals is an excess cash flow sweep, which is leaving aside scheduled amortization. Most lenders want to take, if you have cash flow after EBITDA and capital expenditures and all your restricted payments, if there's money there, sometimes they want 100% of it to pay off, further reduce their exposure. So one of the things you should focus on is trying to make that number less than 100%, so you leave some cash on your balance sheet for a rainy day, or because we all know it is going to rain, or growth, or